I think we'll make a start. We've got sufficient participants for this webinar. Thank you, ladies and gentlemen, for joining us today in this webinar covering the most topical issue of the transition by banks and financial institutions from the traditional interbank offer rate or IBOR to risk-free rates or risk-free reference rates. As you're all aware, the Libor manipulation scandal we saw switch from the British Bankers Association rate to an administration by the Intercontinental Exchange rate and an interpolated rate fixing benchmark rate, which was based on the actual data received by the banks in the interbank deposit transactions, as opposed to the mean average that used to be submitted by banks previously. In this regard, and for today's webinar, I'm joined by my colleagues, Sakshi Puri, who's a senior counsel in our Dubai team and largely handles syndicated bilateral loan transactions, structured finance in Islamic and conventional, as well as our colleague, Madhurima Basu, who's a senior derivatives lawyer based in our Kuwait office. And both Sakshi and Madhurima will be jointly presenting in succession this presentation. If we can move to the agenda, based on the agenda provided, the webinar essentially is divided into two parts. The first session will be presented by Sakshi, which will cover the IBOR transition for a different basket of currencies. And just to make a point, it will be excluding the UAE dirham, which is currently not part of any transition, although the central bank is looking into a consultative paper, but it's not part of a current transition. This will be in relation to the different designated basket of currencies from a general regulatory standpoint, from a market standpoint, particularly in relation to current and future bilateral syndicated loan facilities, RCF facilities on an Islamic and conventional basis. This session will also cover, the first session will also cover dealing with legacy transactions, relevant deadlines, rate switch arrangements within the documentation, and the approach which is taken by the Loan Market Association in terms of the fallback language that goes into the documentation for the benchmark rate to be migrated from the typical IBOR rate to a risk-free rate or risk reference rate. The second part session of the transaction will cover the treatment of the IBOR transition in treasury transactions with a specific focus on the ISDA master agreement. This will cover the ISDA 2020 fallback protocols for legacy transactions, the amendments to the ISDA definition for new deals, the multilateral amendments to the trading documentation covering the master agreements, the credit support documentation, and any collateral documentation protocols. This will also cover any gap analysis, and lastly, it will be covering to deal with Sharia compliant derivatives fairly briefly. Just to note that there are other benchmark rates and indices in the market for US dollar, similar to, by way of example, the Alternative Reference Rate Committee, which is the ARC in the US, and the Bloomberg Short-Term Bank Yield Rate, the BUSBY in the US. However, our focus today is what is the position taken by the LMA and ISDA on the loan and treasury documents respectively. In just a housekeeping point, we'd rather keep the questions at the end. So therefore, I would request you to use the Q&A link provided in the Zoom platform to address your questions, and we will select the questions and answer them accordingly as the time permits. So with further ado, I would like my colleague Sakshi to take us through the alternative rates for the loan documentation.
Thank you, Mahmoud. Before I begin with what the different alternative rates is, I want to start with what is the difference between the historical LIBOR and the new alternative rates, which are called the RFRs or the risk-free rates. The LIBOR is basically essentially a forward-looking rate, which is based on the cost of funds, or it is based on the value that the banks can take loans at in an interbank market. Whereas RFRs are backward-looking rates, which are based on overnight repo transactions between different banks. So it basically RFRs do not allow for manipulation, which was happening in LIBOR related transactions, and that is the reason that the market's now moving from LIBOR based transactions to RFR based transactions. Other key difference that is there in both these is that while LIBOR has a concept of interest period and the fact that you would know your interest to be charged right before the beginning of the interest period, in an RFR based loan, you would not know your interest till you reach the look back period, which is typically 5 days before the interest payment date. So there is an element of uncertainty. You only get to know your interest 5 days before the interest payment date. And the rate is based on the daily cumulative compounded rates of transactions which have been carried forward for the observation period. Now, an observation period is similar to an interest period. So if you have a 1 month interest period, your observation period would be a 1 month observation period. But the difference is that in a transaction which basically has an interest period which begins on 1st January, ends on 30th of January, you would know your interest 2 or 3 days before on the quotation date. Whereas in this case, you would know it 5 days before 30th of January, which is the 25th of January, and would be based on transactions being carried on from 25th of December to 25th of January. So that is how there is a difference in the calculation methodology and the time at which you know what is your interest rate. Another major difference between the two rates is that there is a concept of credit adjustment for RFR based loans. The reason for this is that RFR based loans typically, because they are backward looking and based on actual transactions, the rate provided, the RFR rate would be lower than the LIBOR. In that sense, you do not want the borrower or another counterparty to take an economic benefit of the change in the interest rates. And that's why there is a provision of a credit adjustment so that the rate being charged in a sense is the same as it would have been if you went for a LIBOR instead of an RFR. Moving on, as you can see on the screen, there are different alternative rates for different currencies. For USD, we have the SOFR, which is the secured overnight funding rate. For GBP, there's the SONIA, which is the sterling overnight index. For Japanese yen, that's TONA, that's the Tokyo overnight average rate. For CHF, which is Swiss franc, there's SARON. For Euro, it's the Euro short-term rate. As you can see, most of the administrators for these rates are the central banks of these certain countries. And they have been publishing these rates for a relative, for a substantial period of time, almost 2 years plus. They've all been publishing these rates. Moving on. In terms of where we are now, FCA announced on 5th March that certain LIBOR settings will cease immediately after 31st of December. This is in case of all sterling, euro, Swiss franc, Japanese yen settings. As far as US dollar settings are concerned, only the 1 week and the 2 month LIBOR will cease. The 1 month, 3 months, 6 months, 12 month LIBOR will continue till 30th of June 2023. This is really important for us because most transactions in this region are US dollar transactions which rely on a 1 month, 3 months, 6 months LIBOR. So for those transactions, the LIBOR will still be published till 30th of June 2023. The FCA has mentioned that it does not expect any LIBOR setting to become totally unrepresentative before these dates. And before these dates, you would still be able to use these transactions. Use these the LIBOR settings. Also, another thing that you need to keep in mind is that FCA has allowed for continued publications on a synthetic basis for certain GBP, JPY, and USD settings. But this is only for very tough legacy transactions where an amendment or a transition is not possible. For those, these can be carried out on a synthetic basis. In the UK also, it has been announced that by Q3 2021, there is an aim that all legacy transactions should move to the new risk-free rates. For all, this is for the sterling related loans. So this is another, these dates are very important to keep in mind because these are long stop dates for these transactions or these LIBOR settings. Moving on. Now, there are different approaches that have been given by market participants for LIBOR transition. There's the Alternative Reference Rate Committee in the US, which has a lot of recommendations, methodology for calculation, documentations, trigger events for transition from LIBOR to SOFR. Also, there's a working group for sterling risk-free rates for transition from LIBOR to SONIA. And then there is the LMA, which is something that we follow here and which is something which we've seen in the market being followed, which is the LMA's approach to the LIBOR transition, which to a large extent captures the recommendations of the working group for sterling risk-free rates. Now, the Loan Market Association has come up with 3 approaches for the transition. The first approach being a rate switch approach. In the rate switch approach, what happens is, before I go on to what happens in a rate switch approach, just bear in mind that LMA has already published exposure drafts for the documents for the rate switch approach. These are just exposure drafts. They are still in consultation by market participants. They are still taking recommendations on these drafts, but these are the drafts that are being used by everyone right now for different approaches as they may deem fit. Now, they're all given on the LMA website. LMA has a Microsoft site for LIBOR, and within that, these approaches are given. The first one being the rate switch approach. The rate switch approach basically agrees on a pre-agreed switch term on day 1. So, for example, if you're entering into a loan today, you would agree that till what period would LIBOR continue, and after on what date would LIBOR be shifted to an RFR rate. Now, it would typically either be on a fixed date or would happen on the basis of happening of a certain trigger event. And then there are certain trigger events given, which are related to the administrator ceasing to either publish the relevant LIBOR setting or publishing a rate altogether for that currency, and or there being an announcement by authorities in that country for the LIBOR settings. For example, the USD LIBOR is according to FCA going to continue till 2023 for most of the settings, which is 1, 3, and 6 and 12 months. However, if we have any recommendations locally where it is decided that they would cease to exist after a certain date, we would have to listen to the local recommendations. So therefore, there are 2 limbs to a trigger event. Either an administrator decides to not publish the rate, or the local authorities or there's another order or decree which says that post this, the LIBOR would not be published for this setting and this currency. And there are already pre-agreed rate switch mechanisms for this. You agree what RFR would be calculated, the daily cumulative compounded RFR that would be given. On what date it happens, it would happen after the end of an interest period and upon beginning of a new interest period. And like I mentioned earlier, when we were talking about the differences between LIBOR and RFRs, along with the whole rate switch mechanism and the approach to it, you would also mention the credit adjustment spread. Like I mentioned, this is so that a party does not derive any economic value from this whole transition. Now, the credit adjustment spread could either be a fixed percentage, which the parties agree on day 1, or it could be a formula that is given within the document based on which the credit adjustment spread will be calculated. The benefit of obviously the rate switch approach is that there is no need for an amendment at a later stage in the document once you decide to switch the interest rate. Also, especially for syndicated loans, there is no obligation on the agent to inform the parties of the happening of a trigger event or happening of a rate switch event. And, then you don't have to mention that, from today onwards, the rate is going to be switched. And there's obviously an element of certainty in it. The parties know when it will happen. They know what will be in most cases, they know what the rate would be, similar rate would be, because they agree on a credit adjustment spread, they agree on the margin, and then they have the whole rate switch. So that is one approach to deal with it. The second approach is of the RFR documentation. In this, you use the risk-free rate from day one. So you do not use LIBOR at all. You decide on the risk-free rate today, and you start using that from day one. This again is already given in the single currency term and revolving facilities agreement under the LMA website. And this approach again tells you what rate would be calculated and what would be your credit adjustment spread, and your the alternate rate from day one. This is another way of doing it. And the third approach is where you are uncertain, or where the parties do not want to hardwire do not want to hardwire at this stage, do not want to agree on an alternative rate at this stage. They may agree on just the replacement of a screen rate upon happening of a trigger event, in which case it would either be replaced by another provided reference rate, risk-free rate, or a totally new rate, or it could be that the parties agree that at that stage they enter into negotiations and agree on a totally different rate, which could either be a fixed rate or any other rate that the parties agree. This obviously proves a little bit difficult because the parties have an element of uncertainty where they need to at a later date decide on an interest rate which may or may not be beneficial for both the parties. So, but having said that, there are a lot of banks which are choosing to just stick to giving a mechanism within the document for replacement of the screen rate and not deciding what that replacement would be at this stage. And please bear in mind, in this, you would have to enter into an amendment to the documents at a later stage once you decide what would be your interest rate and once you decide how you're going to replace it. Moving on.
I think one particular point to highlight is that, and this is something we've seen in the market by banks, especially in the SME segment, when they're lending either in trade facilities, short-term loans, or even sort of medium-term loans, that some banks have decided to go for a internal base lending rate, which is essentially is equivalent to their cost of funds, and there is a certain determination that they provided. So instead of relying on a benchmark rate, it would be a base rate, which is usually calculated on the basis of cost on the deposits, cost on the funds, administrative costs, capital charge, risk premiums, and any profit margins. So they consolidate and calculate a internal base lending rate. We've seen that with some of the larger banks and some of the mid-tier banks, which then takes away the uncertainty in terms of any other benchmark rate.
Next steps that are very important for all of you are, obviously splitting your transactions into legacy transactions and any new transactions. And while we are talking about the LMA approach, and LMA typically deals with syndicated loans, this approach can be taken and is being taken for bilateral lendings, any other credit documents which use LIBOR settings, or any other financing documents, any trade facilities which use the USD lending, USD LIBOR. So it's not restricted to syndicated lending. Now, there is a difference. You would have to, for legacy transactions, what needs to be done is to ensure that any transaction which goes beyond the trigger event or which goes beyond the dates which the FCA has published already contain one of the three approaches, whether it's a hardwired approach, whether it's a rate switch approach, or whether it's deciding on replacing the screen rate at a later date post either negotiations or with something which is the market practice. But whatever needs to be done needs to be done now, and then you need to enter into amendment agreements to include that bit in your documentation for legacy transactions. Especially for syndicated loans, it is also very important because the replacement of screen rate or the pre-agreed negotiation terms that the LMA recommends, it provides for any negotiations between the majority lenders and the borrower versus all lenders and borrowers. Typically, interest rates or questions related to interest rates are an all lenders consent issue. But if you already agree in the document today, you would be able to stick to just majority lenders and borrowers entering into negotiations. So that is something you have to do for legacy transactions. And for new transactions, obviously, you have to see what is best for the bank, what you want to do, speak to the borrower about it. If you have a borrower who's ready to fix the rate today, then you move to a rate switch or an hardwired RFR on day one. Then just in terms of certain things that we've seen in the market, in terms of the use of these approaches and the whole transition of LIBOR, is there are issues that we've seen. The first obviously is that, and something that we believe after speaking to a lot of banks, is there's a certain amount of infrastructure and technology involved for adopting this whole risk-free rate, and which the banks currently do not have. So that obviously acts as a hindrance for the banks to move to a risk-free rate or agree to a risk-free rate today. And like I said, most transactions happen in the region in USD and rely on the 1, 3, and 6 months LIBOR, which is not ceasing to exist till 2023. So the banks want to wait and watch and see what will happen rather than agree on an RFR today. The second thing that, as Maman was mentioning, is something that the banks are also considering is moving from LIBOR not to a RFR rate, but actually either their own cost of funds or the central bank base rate, like Bank of India's base rate, Bank of England's base rate. So that is another approach that the banks are doing. Now, there are a lot of banks who've been using cost of funds historically for their transactions. So it becomes easier for them to enter into negotiations with their customers and go in for cost of funds, vis-a-vis banks who've been using transactions based on a widely published LIBOR versus their own cost of funds. So that is another approach that banks are thinking of. Another thing that is an issue with the RFR is the whole element of uncertainty. Now, when you enter into a LIBOR-based transaction, at the beginning of the interest period, you know what your interest rate is. Whereas in an RFR-based transactions, you do not know till about, in most cases, 5 days before your interest payment date. In which case, there is an element of uncertainty for the borrower, and obviously borrowers are not very happy about it. And another issue with uncertainty is the Islamic transactions, where the profit rate that needs to be charged has to be more certain and cannot be uncertain, and needs to be known at the beginning of, for example, a murahaba period. In these kind of situations, a suggestion that a lot of banks are thinking of implementing is to use the RFR of the previous interest period for the current interest period. So rather than using it for the current RFR for this interest period, they would use it for the next interest period. So that's another approach, or that's another way that banks are trying to see if they can tackle this whole issue of uncertainty. This is a very evolving area right now, something which is very important for all of us. There would be, anticipate there'll be more and more developments, there'll be more and more, market practices that come up. There'll be things that we get to know, some things that the banks are more comfortable with or not comfortable with. And we would aim to keep you updated with any new things that we come to know of in the market.
And I think one interesting point is that whilst we are in a transition phase, it's still very uncertain that if a borrower challenges any transition provisions in a UAE court, or for that, by that, from in any court in the GCC, how would that transpire in terms of determination? Whilst there are provisions under UAE law, UAE commercial law, which supports the parties' agreement to such transition provisions, but the uncertainty aspects can sometimes be looked at unfavorably by the courts. So that's another aspect. Of course, invariably in all debt recovery proceedings, an expert is appointed, which is a banking expert or a forensic accountant, which does look at the customary market practice when determining a base rate or the legitimacy of the base rate. So therefore, there is hope that in those situations, given that the expert is appointed, that expert would consider the current rate switches and the mechanism being provided and being adopted by most of the banks, so that any challenges raised by the borrowers or counterparties are essentially covered. In terms of the local regulatory authorities, we understand is that the UAE Central Bank largely is in line with the transition provisions being provided by the FCA. And they're just essentially notifying the respective deadlines for the LIBOR transition to banks. However, in terms of the IBOR transition in the UAE itself, we understand that there was a consultation with the banks end of last year. We don't think there's any working group at the moment, but there's just generally direct consultation with the banks to come up with an approach. But to date, we're not aware that any directions have been provided if the central bank is looking to transition the IBOR similar to other basket currencies, or it will continue the way it is. We'll probably see, given the frequency of legislation by the central bank or the new notification circulars coming out, we'll most likely see something on this issue perhaps later in the year. But at the moment, other than the consultation that took place end of last year, there's no information on the IBOR transition. We understand that for SIBOR, for Saudi Riyal, there is a working group in place by SAMA, and it's a consultative procedure going on. And a lot of banks and law firms are participating in that and giving their recommendations. But again, it's also on a sort of a slow burner. Nothing's come out by SAMA in terms of the Saudi SIBOR transition at the moment. But there is a proper working group in place, and there is a potential sort of recommendations that may come. I think with that, I will request my colleague Madhurima Basu to take us through the impact of the IBOR transition on derivative transactions.
Just before Madhurima starts, if you have any questions, you can put that on the question and answer tab, and we would take them at the end of the presentation.
Thank you, Sakshi. Thank you, Mamoon. We will now be discussing what's happening on the derivatives side. When LIBOR cessation was first confirmed, ISDA set up a working group, and the working group considered what the impact on legacy transactions and new transactions. We will be discussing their conclusions in detail in the next few slides, but in summary, for the legacy transactions, ISDA came up with the 2020 IBOR fallbacks protocol, as well as certain bilateral forms of amendment and template wording. For new transactions, ISDA came up with the supplement to the 2006 ISDA definitions and certain other versions of the definitions as well. But we will also be discussing what the protocol doesn't do and what market participants need to be doing, in particular for cash instrument linked hedges and Sharia compliant derivatives. And finally, we'll discuss the impact of the recent announcement by FCA on the derivatives. Before we get on with that, just a note to make you aware that there is a consultation going on by ISDA right now on the GBP LIBOR ICE swap and USD LIBOR ICE swap rates. So if you do have feedback, please do reach out to ISDA. Now, coming to the 2020 IBOR fallbacks protocol. A protocol is a multilateral way of making an amendment to trading documents. This is certainly not ISDA's first protocol, and ISDA has come up with many over the years. This particular protocol was published on 23rd October 2020 and became effective on 25th January 2021. It amends and restates the fallback language for relevant IBORs, which is Libor with all of the 5 currency settings, the GBP, USD, CHF, Euro, and JPY. But in addition, it also amends and restates the fallbacks for certain other rates, including the Euribor, the Yen Tobor, the BBSW of Australia, the Canadian CDOR, the Hong Kong Interbank Offered Rate, as well as 2 other synthetic rates, which is the swap overnight rate of Singapore and the THB fix of Thailand, because these rates are partly based on USD Libor. Now, while Libor settings are the first being replaced, ISDA has actually restated all of these rates, taking into account that these may also be impacted in future. The protocol itself applies to protocol covered documents. Given this is ISDA's protocol, all of ISDA's documents are definitely covered, which includes the 1992 and the 2002 ISDA master agreements, the various credit support documents, as well as any transaction confirmation. But more crucially, it also includes certain additional documents, which are other master agreements. The key ones for the regional participants are, of course, the GMRA, which is the Global Master Repurchase Agreement, and the Global Master Securities Lending Agreement, which is the GMSLA. But notably, it excludes the ISDA Tahawut Agreement, which is again a very common agreement that most market participants use in the region. Now, how are the legacy contracts amended, or which are the contracts that are actually amended? So the protocol covered documents which incorporate a covered ISDA definition booklet or references a relevant IBOR are the transactions that are amended. The main definitions, of course, are the 2006 ISDA definitions and the 2000 ISDA definitions, but ISDA has actually updated for these relevant rates some older versions of the definitions as well, such as the 91 definitions or the 92 euro definitions. Now, the adherence process, the process itself is very simple. You can go to ISDA's website pay a one-time cost and adhere to it. As of Friday, which is the 18th of June, there were 14,219 adherents for this protocol. So you can imagine that this is a very popular protocol from ISDA. And indeed, because of the coverage which impacts most market participants. Now, with regard to timing, when are the amendments to legacy contracts become valid? Now, if both parties adhere to the protocol before the effective date of 25th January 2021, the amendments become effective from 25th January 2021. But if either party or both parties adhered after the effective date, then it's the date the later of the 2 parties adhered is when the amendments become effective. I'll give you an example. So one party adhered on the 15th of January 2021, but the other party adheres on 5th April 2021. Between these 2 parties, the amendments become effective from 5th April 2021. Moving on to the bilateral forms. So other than the protocol, ISDA also published 3 forms of bilateral amendment agreements. 2 forms of these were to adopt the protocol if one or both parties don't actually adhere to the protocol, but have affected legacy transactions between them. And the 3rd form is for parties who have actually adhered to the protocol, and we'll come into why that is required. And all of these 3 forms are available on for both principal as well as agency versions. With the first form of amendment is the short form amendment. It incorporates the ISDA fallback protocol by reference, and entering into an amendment like this has the same effect as both parties adhering to the protocol. ISDA also came up with the second form, which is the long form amendment to adopt the protocol. It incorporates the full text of the IBOR fallbacks protocol. And the key point is it allows for amendments to the text of the IBOR fallbacks protocol should two parties actually want to make changes. Now, if you're not going to make any changes, it's just easier to enter into the short form amendment. But of course, the long form amendment gives you a lot more flexibility to make changes. And the third form of amendment are for parties who have adhered to the ISDA fallbacks protocol, but for certain transactions or master agreements, they actually don't want to make those changes. So when they entered into or adhered to the protocol, the changes were already made, and this amendment actually reverses the changes made. So it's not that these changes were not made. These were made, and then you're reversing back for certain particular master agreements or transactions. In addition to this, ISDA also published supplemental wording for particular situation. These can be added to other bilateral forms of amendments similar to the ones we saw before, but these are not template amendments by themselves. So you can't just pick it up and sign them. You have to put this into another form of amendment agreement to agree those with the counterparties. The template wording covers various situations. One of the main things is to exclude the protocol covered documents from the purview of the IBOR fallbacks protocol for various reasons, which include if you have provided for triggers and fallbacks to match a cash hedged instrument, which is either bond or a syndicated facility, or if you have negotiated separate fallbacks, or if you have fallbacks in a separate document, or any of this combination. So you can use this wording to exclude the protocol covered certain protocol covered documents from the purview of the protocol. It also helps in applying the terms of the IBOR fallback protocol to certain new agreements which do not actually incorporate the 2006 ISDA definitions or which do not reference a relevant IBOR. And finally, it also provides some language to disapply the pre-cessation fallback, which is hardwired into IBOR fallbacks protocol for Libor. So essentially, if FCA or a regulator states that Libor is no longer representative of market, that would be considered a pre-cessation trigger, and the fallbacks would start applying immediately, even though Libor rates are still available. This is hardwired into the IBOR fallbacks protocol, but ISDA has included language which you can adopt with your counterparty if you want to retain Libor till the end of its term. Having said that, the FCA's announcement of 5th of March does say that they consider this event to be extremely unlikely. Now, the supplement to the 2006 ISDA definitions. These set of definitions were published in 2006, and ISDA has kept it current by publishing various supplements over the last 15 years. The key one, of course, the most recent one, is the 70th supplement. So you can imagine that this supplement process happens quite a few times. This particular supplement amends and restates the fallbacks for the relevant IBORs, and it applies to all new transactions entered into after the 25th of January 2021 that incorporates the 2006 ISDA definitions, as well as all legacy transactions which incorporate the 2006 ISDA definitions, and both parties have either adhered to the protocol or bilaterally adopted the protocol through an amendment agreement. The way the fallbacks are now designed is there is a fallback waterfall. So it's not only one fallback, but has successive fallbacks for each of these rates. The primary fallback, of course, is on the occurrence of the index cessation event or the pre-cessation event, which is when the rates are no longer representative of the market. And there is a move to the adjusted risk-free rates plus spread. But given this occurred once, ISDA has also tried to make it future-proof by having further fallbacks, so when the primary fallback rates are discontinued for any reason. On ISDA's announcement from the 5th of March, the announcement itself can be considered the index cessation event in respect of all Libor rates. The index cessation effective date would be the 1st of July 2023 for the certain USD currencies of IBOR, as well as 1st January 2022 for all other LIBOR rates. So all of the GBP, JPY, and the other rates, and certain of the USD rates which are ceasing on 31st of December of this year. Moreover, the spreads were fixed on the 5th of January 2021 based on FCA's announcement, which is the risk adjustment spread for the RFRs. And the announcement itself said the pre-cessation announcement is not expected to, FCA doesn't expect LIBOR to become unrepresentative before these dates. Now, coming on to what the protocol doesn't do. One key point that is very relevant in the market is cash instrument link swaps. The borrower and hedge counterparties may have hedged an underlying cash instrument and are contractually obligated to follow another rate, which is to follow the rate under the cash instrument. The other thing is the parties might just want to follow the cash instrument because that is what they tried to hedge in the first place. So it is time to engage with your counterparties bilaterally to see where you are and whether you want to follow or whether you have to follow the cash instrument or you can follow the IBOR fallbacks protocol. For regional institutions, certain institutions also enter into back-to-back swaps. And if the main swap, which is cash instrument linked, moves in the route of the cash instrument and the back-to-back hedge is moves in the direction of the fallbacks protocol, there might be a basis risk. So it is worth checking those trades and see whether you're happy with that risk or engage with your counterparties. The other big point in the protocol, what it doesn't do, is the Sharia compliant derivatives. So is the tahawud is excluded from the IBOR fallbacks protocol, but taking a step back, IBORs are not actually included in the pre-printed form of the tahawud agreement or any of the undertakings, though if you have a profit rate swap, it is very likely that you have included an IBOR in the confirmation. The IIFM of Bahrain is taking initiatives in making changes and have also brought out a white paper. The white paper discusses the feasibility of a protocol, but concludes that it is unlikely that a protocol is going to work because there is really no one-size-fits-all approach in the Sharia compliant hedging world. Because you're not only changing the rate, you're also changing the structure, because the Sharia compliance structures need more certainty than what is provided in adjusted RFRs. Other than that, the IIFM is also consulting on fallback clauses for RFR related amendments, and we are awaiting the results of that. Now, next steps. We've gone through what the protocol is, what the supplement is, and what the protocol doesn't do. So what should the next steps be for you? And the next steps first is a gap analysis. It is important to look into what trades you have in place. Do you have GBP trades or do you only have USD trades? So do you have time or do you not have time? Are your trades linked to cash instruments? Do you have back-to-back swaps? All of these need to be considered, and there really is no substitute for due diligence. Now, for the protocol itself, have you adhered to the protocol? And given the number of adherents that there are, I would assume most participants have already done so. But if you have not, there is time to do so. Please go ahead and do this. The other thing you need to check is whether your counterparty has signed up to the protocol. If not, you should be signing a bilateral amendment with your counterparty with relevant carve-outs depending on the trades that you have in place. And for counterparties who have adhered to the protocol, do you actually need to make changes to particular transactions or documents? Do think about that, and if required, you might need to enter into a bilateral amendment again. And you also need to identify the relevant Sharia compliant documents and when these changes are being made so that you can consider what changes are required. We are, of course, waiting for IIFM's amendments, recommended amendments, but if you're a Sharia compliant institution, you might want to engage with your Sharia boards right now to think about what structures are acceptable. For new transactions, definitely ensure that the 2006 ISDA definitions are incorporated as of now. You might be aware that ISDA has also published the 2021 ISDA definitions, though they come into effect in October. So after that time, do consider including the 2021 ISDA definitions into your transactions. For cash instrument linked hedges, you might need to update the confirmation so that the loan and the hedge is matched if that is contractually required or commercially wanted. And finally, for Sharia compliant trades, talk to your Sharia boards, update the template language to the extent you can, or discuss with IIFM on what the next steps are. We will, of course, be updating the market participants when IIFM comes up with the new suggested language. With that, we are at the end of our prepared presentation, and we'll be happy to take questions now. Mamoon, Sakshi, would you like to moderate?
Thank you, Madhurima. With this, we would open the forum for question and answers. We have a few questions already in there. This first, which says, could you share some updates of the UAE or Middle East markets, current status regarding Libor transitions? Have you seen any loans quoting alternative RFRs already? To answer your question, yes, we have seen, but like I mentioned, not too many, and the ones that we have seen are not just, they are ones which have foreign banks involved, and is probably in more syndicated loans, which are beginning today and would go on for the next 5, 6, 7 years, long-term loans. But using them for bilateral transactions, we haven't seen a lot of that. We've just probably seen 1 or 2. There are certain banks who are already in discussions with us and who are looking to update their standard documents for moving to RFR based loans. So like I said, not too much, but we've already seen some traction on this.
Of course, we've seen quite a few banks whose loans are perhaps ending in 1 or 2 years to amend and include the necessary fallback language. I think that's
that is something we've seen. Almost all banks are doing something that they're all doing, and this is something everyone has to do, is making sure they have some fallback language in there. They have the normal replacement of screen-laid language, which allows them to amend it at a later stage, which is based on a fixed amendment to a rate which will replace the LIBOR, or to enter into a negotiation at a later stage. But that whole understanding is already being put in place by most banks.
The second question is, are we expecting any guidance from the DFSA in relation to, I think this is in relation to authorized firms or category 1 or category 2 banks or Islamic financial institutions in the DIFC. We've not seen any direction from the DFSA officially. What we are given to understand is that they're perhaps engaging with the authorized firms directly. So in terms of their periodic audits, we understand they do mention and discuss any LIBOR transitions for any loan transactions, any derivative transactions. We also understand that they're looking at from a risk-based perspective, and they look at authorized firms, a volume of loans, the portfolio they have, the number of loans with the basket of currencies, and then give the recommendations. They're also looking at what is the, I guess, the infrastructure put in place for the transition. So the DFSA is looking at the fact that whether there's significant or necessary internal controls to do the transition suitably, whether it's a rate switch or other mechanisms provided through documentation, as well as the internal systems provided for in the authorized firms infrastructure. I think that's broadly what the DFSA's view is, but we've not seen any formal guidance from them. Most likely we might see something later, but not anything at this stage. So we do have 10 minutes left. We're here. If you have any other questions you'd like to you would like us to address, we'll be here till 1 o'clock to answer these for myself, Sakshi, and Madhurima on the treasury side. Otherwise, please feel free to reach out to us by email directly if you would like to discuss any specific sort of example, illustration, or transaction that you would like us to look at. As I mentioned earlier, we are currently in the process of advising quite a few banks in terms of legacy transactions and making amendments to the existing documentations. It happens either circumstantially that we have these trade facilities that have been renewed on an annual basis, and at the end of each quarter, they're coming to us in terms of including the necessary fallback language, or it is in relation to a specific transaction where either an RFR rate being introduced or again a fallback language needs to go into these documents. So we are doing quite a bit of work. We've I think got significant experience on the loan side as well as on the treasury side with Madhurima to do that, and we'll be happy to look at individual transactions from your side. But as I said, we are here till 1 o'clock if you have any questions.
There's another question. Is there any information on its applicability to IBOR? Nothing right now, like Mamun had mentioned, there's nothing by central bank right now, no working group. There have been certain consultations that the central banks had with banks, but there's been no working group that's been established, and there's nothing that has been done in that space till now. Any other questions?
I think I can see people leaving the Zoom platform. So thank you very much for attending this call, this webinar. We will perhaps have 1 or 2 more sessions. There'll be one more session perhaps before the summer break, and then we probably sort of continue with some of the regional banks later. Yes, we will send across the presentations to the group that was today.